Let's not miss out on tax planning opportunities in 2024 by missing the deadline. Today, we will be looking at using these strategies to help reduce for and plan for tax, utilizing losses, deferring income, using negative gearing on investments, and reviewing your business structure. We'll also quickly look at bonuses and dividends, plus paying into superannuation as a way to reduce your tax bill. Plus, if you stay until the end, I have a couple of bonuses for you which you might find useful. The first thing we really need to cover off on here is the end of year deadline. In Australia, the end of the financial year is 30 June. So this means that if you're planning on doing anything to help with your tax bill, it needs to be done before this date. Otherwise, it won't count in this tax return. It will have to count towards the next tax return. The time for tax planning is right now. And this is because it gives us all a chance to make sure that everything is done, all the boxes are ticked, all the ducks are in a row, ready to go for the end of the financial year. To kick things off, we're going to be looking at losses. Any seasoned business owner will tell you there are two types of losses. There are losses that you generate from your business activities, otherwise known as revenue losses, and then there are those losses that you generate from the sale of assets, otherwise known as capital losses. You make revenue losses when your business expenses are greater than your business income, and you can, generally speaking, carry these losses for an indefinite period of time, provided you meet certain criteria outlined in the Tax Act. Broadly speaking, however, if your business remains the same structure on the day that you want to use the losses as the day that you made the losses, then you should be able to use the losses without any problem whatsoever. Revenue losses are always used before capital losses, and they are used in the order in which you made them. So for example, if you made a revenue loss in 2020, 2021, 2022, and 2023, you will be using the loss that you made in 2020 first. How do losses help you? Aren't they a sign of a business failing? Look, losses are never something that you outwardly set out to achieve. However, there might be times when your costs actually are out of sync with the income that you are producing. Mining companies are a fantastic example of this. So they may spend years going out and looking at sites to determine whether or not they are actually suitable to dig a hole, dig out the ore, and sell it on the open market and make money from it. How does this benefit you today? Well, you can use losses that you made in previous years to offset the profit that you are making in the current year and therefore reduce your tax bill. Think of it as the reward for your blood, sweat, and tears in years of business hardship. Can you use losses to reduce your profit to nil? Absolutely you can. And what's more, any losses that are left over after reducing your profit to nil can continue to be carried forward to use in a future year. So that's revenue losses, but what if you've only got capital losses? Sadly, capital losses can't be used to offset profit. However, they can be carried forward indefinitely to be able to be used in a future year against a capital gain. A capital loss is made when an asset of some variety, so think shares or an investment property, is sold for less than what it was bought for. Because the loss can't be used to reduce a profit, it has to be carried forward until a gain is made. What if you don't ever make a capital gain? Well, the loss just sits there indefinitely. The trick to capital gains and losses is to sell assets that are going to make a capital loss before the ones that are going to make a capital gain. A loss can only be carried forward, it can't be carried backwards. Therefore, if you sell the loss-making asset first, we can carry forward that loss to such a point in time and use it against the asset that's going to make a capital gain at some point. The next item on our tax planning checklist is the deferral of income. What benefit does this have? If you are a small business, you are taxed on what's called a cash basis, and that means that you are only taxed on income that you actually receive in the financial year, and you only take a tax deduction for amounts that you actually spend in a financial year. So a way to help with managing your tax bill is to do a little forward planning around the issuing of invoices when we're coming towards the end of the financial year. Most businesses, generally speaking, will have some sort of terms of trade. That is, they won't be paid the instant that they issue the invoice. They may actually receive the income anything up to 30 days after the invoice is issued. So come June, if as a result of doing some tax planning, you have a bit of a tax bill coming, what you can do is when you issue your invoices in June, make the date payable for those invoices sometime in July. What does this mean? Well, most businesses will pay their invoices on or about the due date. So this will mean that you will actually receive the income from those invoices in July and therefore push out the taxing point on that revenue until the following financial year. This reduces your profit in the current financial year and therefore your tax bill. Is it legal? Absolutely it's legal. We're not saying we're not going to include the income at all. We're just pushing out the point at which we receive the income. A similar thing should be done in reverse for expenses at the end of the financial year. As I said before, you only include as a tax deduction amounts that you have actually spent during a financial year. Therefore, if you've received bills at the end of the year, think like the phone bill, the internet bill, some sort of supplier bill, but you're not due to pay it until July, If you go ahead and pay those amounts in June, then you bring forward the tax deduction point and you pull that amount into your profit number, reduce your profit, and again, you reduce your tax bill. Next, we come to investments. First thing we need to do is understand the difference between a positively geared investment and a negatively geared investment. A positively geared investment is one in which the amount of money that you make on the investment is greater than the amount of money that you need to spend on the investment each year, and you therefore make a profit on the investment. It follows, therefore, that a negatively geared investment is one where the expenses are actually higher than the income on the investment. Now, normally I would advocate for a positively geared investment because for the long term, they are a better investment to hold. Having an asset in your portfolio that is actually making you money and can replace an income stream or support you in your retirement is actually something of great benefit. However, from a purely tax point of view, a negatively geared investment is very much the way to go. Why, do you ask me? Well, it's because you can take the loss made on the negatively geared investment and use it to reduce the income that you are earning, and in doing so, you reduce your tax bill. So from a tax planning point of view, having a negatively geared asset in your portfolio is very much a bonus. It becomes a lot more useful the higher the income that you're earning. So as a business owner, if you're wanting to draw funds from your business, having a negatively geared asset in your portfolio can be a really useful asset to have, because it can help us to reduce your tax bill and prevent any unwanted pay-as-you-go installments, which leads us quite neatly into reviewing your business structure. Many businesses in Australia are set up as sole traders or partnerships or trusts. Whilst each has their benefits, the one negative they all have in common is around the distribution of profits and how it's treated in the hands of the people receiving it. I have done a video previously around the pros and cons of the business structures in Australia, and I will leave a link to it in the description box below for you to watch later. However, the guts of it is that sole traders, beneficiaries, and partners in partnerships are all taxed on the profit they receive at their marginal tax rates. The only real way to control this is through the use of a company. With the use of a company, the owners of the company can be treated as employees and they can receive a salary just the same as all their other employees. This controls the amount of tax they need to pay, and in a lot of cases can either reduce or get rid of completely the pesky quarterly pay-as-you-go installments that are being paid. With a company, the profit remains within the company and is taxed at the company tax rate of 25% for most small businesses. Should the owners want to take out money at the end of the year, it can be done through a bonus or a dividend depending on their circumstances. A bonus payment can be made at any point during the financial year depending on the business's needs. However, if as a result of doing your tax planning, it is determined that a bonus could be made to key members of staff and the owners, then a declaration can be made before the end of the financial year. Now, in contrast to everything I have told you previously about the deductibility of expenses, with a bonus, we can take a deduction for the bonus when it is declared. So provided the declaration is made and signed off on before 30 June, we can take a tax deduction for it in the current financial year, but only pay for it when, say, the cash comes in July. The key thing to remember here is making sure that the minute is signed off before the 30th of June. Dividends may also be used as a way of distributing cash before the end of the financial year. However, unlike a bonus, a dividend is not tax deductible. The consideration here becomes the use of franking credits and whether or not there are enough franking credits within the business to be able to pay a fully franked dividend. What is a franking credit? Well, a franking credit is very basically the amount of tax the business has actually paid during the financial year. If no tax or very little tax has been paid, then it's going to be very difficult to pay a fully franked dividend. You're going to have to look at a different alternative, such as an unfranked dividend or a partially franked dividend. Last on my list of things to talk about before we go on to bonuses is the use of superannuation as a way of reducing your tax bill. As at the date of recording, Australian taxpayers could contribute up to $27,500 into their superannuation fund each year. This includes employer contributions, salary sacrifice contributions, and post-tax contributions. How does this help with your tax bill? If your business contributes, say, $15,000 in employer contributions into your super fund during the year, you can top that amount up to $27,500 via the use of after-tax contributions. You can then claim a tax deduction for those after-tax contributions in your tax return. So in this example, you may want to contribute $12,500 into your super fund from your post-tax salary. Now, provided the paperwork is filled in correctly, you should be able to take a tax deduction for that $12,500 in your tax return. A word to the wise. This is an extremely useful strategy and one of my favorites when it comes to tax planning. However, you do need to be careful. If you accidentally contribute too much, there are tax penalties which will apply, which will render the whole thing absolutely pointless. Talk to your accountant and or your financial planner first before you go ahead and do anything to make sure you're not going down the wrong path. Now, before I go on to my bonuses, if you've learned one useful thing in this video, perhaps you would consider going ahead and clicking on the thumbs up. If you've learned two useful things in this video, perhaps you'd go ahead and hit the subscribe button to help small channels like this one continue to make useful content for you. Bonus number one. As a business owner, there are a number of things that you need to check off on before the end of the financial year to make sure that your business remains compliant. If you are a trust or a company, the two things that you need to be doing are a solvency resolution or a profit distribution resolution. Both minutes need to be signed off before 30 June. How do you know whether or not you're going to be able to sign off on them? You need to do some tax planning. That's the only way you're going to know the numbers to put into the minutes. I will leave a template for both of these minutes in the description box below for you to download. Don't be tempted to backdate these minutes. The ATO have cottoned on to this one, and I have seen over the course of my career when they're really determined to find something that they will go ahead and question the validity of minutes and when they were signed. With the advent of digital signatures, most of the software will automatically populate the date on which you sign a minute, so it will populate on today's date, so backdating it is fast becoming a thing of the past. So make sure this is all done before the end of the financial year. Bonus number two, I have a checklist of items that you need to check off on before the end of the financial year to make sure that you are actually ready to go for 30 June. I will leave this in the description box below for you to download and use at your leisure. Otherwise, I hope you have found this video useful today. I will leave you with this one to watch next, and I will catch you in the next one. Thank you so much for watching.